Hello everyone. This video is the first of two videos that we're going to have for the topic of bond prices and yields for the spring 2020 course for BU 483. In this section I'm going to go through, in this video I'm going to go through the first 6 pages of the notes on bond prices and yields, and then the second video I'm going to make, we'll go through the second 6 pages for that. So just to start off with some bond terminology. A bond is a debt security issued by the borrower to the lender in exchange for cash. Just a few things I want to add in here. We have issuers. These are the firms that issue the bonds and receive the proceeds from the issuance. So for example, if you buy a Walmart bond, well, the original issuer of that bond was Walmart. If you buy a bond issued by Apple, they're the issuer. The counterparty to that is going to be your investor, and that's also going to be the bondholder. Another thing that I want you to know going into this is that bonds are usually traded through bond dealers. There's not an organized exchange for bonds, so whenever you want to buy or sell a bond, this is done through a dealer, usually through an electronic network. Okay, so the first types of bonds we'll talk about are coupon bonds, and coupon bonds are bonds that pay interest payments typically twice per year. They get their name from when bonds originated, in which you would actually receive a paper bond, and on that bond would be little coupons. So anytime when it was time for you to receive your bond payment, you'd actually tear off a coupon, you'd stick it in the mail, you'd send it to the issuer, and they would send you back a check. We don't do that anymore. Now it's done electronically, but the name stuck. A zero coupon bond is a bond that does not make interest payments. And these are frequently referred to as pure discount bonds. These are bonds that are sold at a discount to their par value or their face value, which we'll talk about next. And the return that an investor receives on these is the difference between what they purchased them for and what they get back at maturity. These tend to be shorter term than coupon bonds. We'll talk a little bit more about that later when we talk about government bonds. The par value, also known as the face value, or also known as the principal value, And when I use the term maturity, this is the date when the bond matures, when it expires. It's the last date of the bond's existence. After that, you don't earn interest on it anymore, and it's the date that the principal, the total principal value of the bond is due. The bond indenture is an agreement between the issuer and the investor that includes any repayment terms, collateral, and provisions governing the bond. And these can include things like positive covenants saying that the bond issuer has to do certain things like maintain certain ratios, or negative covenants which restrict the issuer from doing specific things like taking on additional debt. It's gonna go through what the repayment terms are, how much each coupon payment's supposed to be, when the principal is supposed to be repaid, and things like that. The yield to maturity is the average annual return, or the annual return received if the bond is held until the maturity date. As we'll see later, the return from the bond comes from both its interest payment and also the change in the bond price. As I mentioned before, bonds are traded between, or bonds are traded through bond dealers. And so the bid price is the price at which the bond dealer is willing to buy the bond. The ask price is the price at which the dealer is willing to sell the bond. Dealers make their money, they earn their profit through what's called the bid-ask spread. And so the more risk involved with a bond in terms of its liquidity, so for example, if there's not a lot of people interested in buying and selling that bond and trading that bond, then that bid-ask spread is going to get even larger because the dealers are taking on more risk, and there's more risk they're going to be left holding a bond that they don't want, or maybe it's riskier than what they would like. So the more liquid a bond is, in other words, the more buyers and sellers there are for that bond, the lower or the smaller that spread's going to be. The fewer, the less liquid a bond is, the greater that bid-ask spread is going to be. So Treasury bills, notes, and bonds. So these refer to U.S. Treasury bills, notes, and bonds. Bills, and these are all issued by the government, the U.S. government. They're considered to be free of default risk. So I'll just put that up here. So bills are government securities that have an initial maturity of fewer than 12 months. They are pure discount or zero coupon bonds. Of 12 months or fewer. These are zero coupon bonds. So they're sold at a discount to their face value, and whenever they mature, you're going to receive the face value of that bond. A note has an original maturity of between 1 year and 10 years. These are not zero coupon bonds. They make it a semi-annual coupon payment. And U.S. government bonds, sorry about this, this should say have instead of has. So bonds have an original maturity of more than 10 years. They also make a semi-annual coupon payment. These usually go up to about 30 years to maturity. They can go longer, but that's very rare. There was a time in the 1990s where the U.S. government actually got rid of the 30-year bond. They stopped issuing those. Outstanding ones still existed, but they stopped issuing 30-year bonds because interest rates were higher. And so locking in a high interest rate for 30 years didn't make a lot of sense. And so they really pushed on having shorter term maturities for the bonds that the government was issuing, so the interest payments would be less every year. This can cause some risk in the future, though, because if you're only issuing short-term bonds and interest rates go up significantly, then when the government has to refinance those bonds, essentially they have to pay them off, pay the principal loss, and then reissue bonds to make up for that amount. They're going to be paying a much higher interest rate. So it's kind of a trade-off between risk and lowering the interest rate that they're going to have to pay off for longer periods of time. So I've got some U.S. Treasury quotes here. These are from the Wall Street Journal from February 21st, 2019, so a little over a year ago. You can see here that we've got different maturity dates. The maturity dates go up as we look out there. So here we've got a 30-year bond, 20-year bonds, 10-year bonds, 5-year bonds, 1-year bonds, and then ones that were maturing within a week of the quotes here. So these are the coupon rates. So those are the rates at which the coupon payments were based on. The bid and the ask prices are based on a par value of $100. When we work our bond problems, we're going to use a par value of 1,000, but these are just how government bonds are quoted. You can see the ask price is greater than the bid price. For these bonds, because they're highly liquid, the bid-ask spread is very small. In this case, it's less than, it's less than 2 cents on a par value of $100. And then this is the yield. So this would be your yield to maturity for these bonds based on the ask price. When bonds are traded between different investors, there's going to be a clean price, and that's going to be the price that's being quoted. So in this case, the ask price on here would be your clean price. The dirty price includes the accrued interest. So if you think about it, let's say that the bond pays semi-annual interest payments, and let's say I buy the bond when it's 3 months into the, we're in the middle of the time period between which the interest is paid. When I buy the bond today, the person I'm buying the bond from, the other investor I'm buying the bond from, is not going to receive that interest for the previous 3 months, because I'm going to get the entire 6 months worth of interest whenever I receive the coupon payment, okay, at the end of the next 3 months. So I'm going to have to pay that investor not only the ask price, or the bond dealer, I'm going to have to pay them the ask price. I'm also going to have to pay them the accrued interest on that bond. And so the clean price is the price without the accrued interest. The dirty price is the price that you'd pay for the bond that includes the accrued interest. The way we calculate this, assuming semi-annual payments, is as follows. The accrued interest is equal to the annual coupon payment divided by 2, multiplied by the days since the last coupon payment divided by the days separating coupon payments. So I've got an example problem here. What is the accrued interest for a bond that has an annual coupon payment of $60, 182 days separating the coupon payments, and 80 days since the last coupon payment? So to calculate this, I'm going to take my annual coupon payment, $60. The days since the last coupon payment was 80 days. And there's 182 days, so that's, multiply that by 2, you get 364. So that's essentially 6 months, which would be normal for a bond. Oops. So whenever I calculate that, I get 30, so that's 60 divided by 2, multiplied by 80 divided by 182, so that gives me $13.19. So if the clean price of the bond today was $9.75, and so that would be the asked price, what price would you pay if you purchased the bond today? You'd pay $9.75, the clean price, plus $13.19, and that's going to be equal to $988.19. So the next topic is corporate bonds, and corporate bonds are bonds issued by corporations. They typically have up to a 30-year maturity originally. They can go longer on this. I've seen longer ones on mortgage-backed bonds. So whenever the bond is being issued to pay for a large building, I've seen these go up to 40 years before. They can certainly go longer than 30, but that's usually the maximum you'll see bonds issued for typically. They can certainly be shorter. In fact, we see that quite a bit whenever a company just wants to issue a bond for 5 or 10 years to complete a project. So they usually have up to a 30-year maturity, and they usually make coupon payments semi-annually. So down below I've got bond quotes for Jcpenney, and this came from last February as well, February 2019 as well. And so what we've got here is we've got the seniority, which we'll talk about a little bit later. You can see that these are all senior bonds. They're either unsecured or secured. And the difference between the two is that for unsecured bonds, there's no specific collateral. Secured bonds will always have collateral. It's typically going to be real estate backing that up, but not always. Sometimes you'll see these being backed up just by the regular security interest placed on the working capital of the company or on equipment of the company. So we can look at here and see what their annual coupon rates are. So they range from 8.265% down to 5.65%. The offer dates are going to have an effect on that. The offering amount, these are in millions of dollars. So this one with a maturity date of October 2019 had an offering amount of $400 million. So that's going to be your principal value. The one for maturing in June 1st of 2020 had an offering amount of $400 million. The next one, $500 million, $500 million, and so on. So these are pretty large amounts for a bond. Then you've got the amount outstanding. So you'll notice that these aren't matured yet, and yet they have less outstanding than their offering amount. And that's because oftentimes companies, issuers, will pay down bonds, and sometimes they have a sinking fund for which they'll use to pay down that bond during the life of the bond. The current price, and again, these are quoted in terms of $100 par value. You can see this one, which was originally issued as a 40-year bond, has a very low price, and that's because it's got a long time until its maturity. The yield, so YTW from Standard & Poor's Capital IQ refers to as yield to worst. I mentioned what yield to maturity was before. Yield to worst is the yield to either the time for the bond to be called, if it's a callable bond, or the time to maturity, or if there's any other provision in there that might change the length of the time until the bond can be turned in or will be turned in to the issuer for money. And the yield to worst is the time period out in the future at which that can take place that would result in the lowest yield to maturity. For most, if not all of these bonds, this is going to be the yield to maturity unless they're callable or unless they're putable bonds. You can see here the S&P rating for these bonds is actually really low. These two B bonds here are secured. The rest of them, this one is secured too, senior secured, but still has a bad bond rating. These would be considered, all of these would be considered to be junk bonds or speculative bonds because Jcpenney hasn't been doing too well. The next one we're going to talk about is the call provision for a bond. And callable bonds are bonds that the investor can be forced to sell to the issuer. And what happens here is, let's say that the issuer decides that they want to mature the bonds early or repurchase the bonds early before the maturity date. They can go to the investor, and for a predetermined price, they can tell the investor that they have to sell the bond back to them. For this reason, they're considered to be a little more risky because you're not going to get that yield to maturity that you originally expected. So they usually have a higher yield to maturity than non-callable bonds and sell for less than a comparable non-callable bond. So the call premium is the amount above The call premium is the amount above the call price that the issuer is required to pay the investor if the bond is called. So let's say that that issuer wants to call that bond. They'll usually have to pay an amount above the regular par value that the investor would get in order to make that happen. And that's going to be set forth in the bond indenture. The deferred call provision sets out an initial amount of time after the bond is issued that the issuer has to wait to call the bond. And this is a protection for the investor, so they don't go out and buy a bond today, pay the commissions and fees associated with that, and then the next day the issuer says, okay, I'm going to call the bond now. And so you've now lost that bond as the bond investor. These can be a few years. So let's say you buy a callable bond. It's issued today. It's not callable for the next 3 years. And so the call date would be 3 years from now, or the first call date would be 3 years from now. After that time, then the issuer has the right to call the bond at any time. The next type of bond we'll talk about are convertible bonds. So convertible bonds give bondholders an option to exchange each bond for a specified number of shares of common stock of the firm. The conversion ratio is the number of shares for which the bond may be exchanged. The market conversion value is the current value of the shares for which the bond may be exchanged. The conversion premium is the excess of the bond value over its conversion value. So I'm going to give you an example here. If a bond with a current price of $1,100 has a conversion ratio of 20, and the stock is selling for $42 per share, what's the current conversion premium? So the first thing we need to figure out is how much is that stock worth? So we take 20 times 42 and we get 840. So the conversion premium is going to be the difference between that $1,100 and that $840. Or $260. So would we want to, if we were the investor now and we own this bond, would we want to convert it? And the answer is no, because if we converted it today, we'd be giving up something worth $1,100 for stock only worth $840. So it wouldn't make sense to convert today. Above which stock price would it benefit the bondholder to convert at the bond price? And this ignores any kind of commissions or anything that you might have to pay in order to do this. So in order to find this number, we're going to take $1,100 and we're going to divide it by 20. And that's going to get us $55 per share. So if the stock price went above $55 per share, we might really want to consider, as long as the bond price hasn't changed, we might really want to consider converting that, because now we're going to get something worth more than the $1,100 when we convert that into shares of stock. So why do companies issue convertible shares? It's a way for them to pay a lower yield or pay a lower coupon rate for the proceeds of that bond, because it gives the investor another benefit of buying that bond. So let's say the stock price goes way up. Okay? As a bondholder, I can take advantage of that increase in stock price. If this was not a convertible bond, that feature wouldn't be there. And so the company might have to pay a higher rate of return on those bonds because they don't have that feature. The next kind of bond, we've talked about callable bonds and convertible bonds. The next type of bond is called a pitiable bond. put bonds are bonds, or puttable bonds, are bonds that give the bondholder the right to retire the bond early. So this, again, is the investor, the right to retire the bond early and receive the principal value of the bond early. So an example of this might be that I purchased a bond in a firm. The firm has gotten riskier. Maybe there's a greater threat of bankruptcy for this firm, or a greater threat of default on my bond, and I might say, look, I'm not interested in this anymore. And I go to them and I require them to buy the bond back from me. And in this case, with a put bond, I'm going to receive my principal value early. So I'm going to receive my $1,000 face value. If that's the face value of the bond, I'm going to receive that whenever I decide to activate that put. Under what conditions would a bondholder want to exercise the put option? If the firm has increased its riskiness. Because what's going to happen to the bond in this case is that the bond value is going to go down. What I'm really looking for as an investor is if that bond value goes down below the par value. So let's say I have a bond that's worth $900 in the marketplace, but I can exercise that put option on the bond and receive $1,000. So if the firm has increased its riskiness and or if interest rates have increased. Because both of these things are going to increase the yield to maturity on the bond, and that's going to lower the bond price. The next type of bonds are floating rate bonds. Most floating rate bonds have the following, floating rate bonds are bonds for which the coupon rate changes with, oftentimes with an index rate. So again, these bonds float, their coupon rate floats or changes with an index rate or other underlying rate of return on an investment. Most floating rate bonds have the following features. One, they have a put provision, and so this protects the investor in case those rates, in case the value of the bond falls because of the floating rates. A collar is a very typical thing to see on these types of bonds, and a collar sets a maximum rate that the bond will pay and a minimum rate that the bond will pay. The minimum rate protects the investor. And the maximum rate protects the issuer. Preferred stock is a hybrid security Sorry about that. That is a form of equity, but acts like a bond. Like a bond, a share of preferred stock has a stated value, and this is also known as the par value of the bond, or excuse me, the par value of the stock. This is a fixed value on which the preferred dividend is set, and the value that the investor receives in liquidation if the firm goes bankrupt. The odds are that, oftentimes at least, that if someone does invest in preferred stock and the company does go through liquidation or Chapter 7 bankruptcy, that they're actually not going to get that stated value because there's not enough money left over. However, they have to receive that stated value or that par value for that stock in order for common stockholders to receive anything. So if the firm isn't able to pay them back that stated value, then the common stockholders receive nothing. The dividends for preferred stock are fixed and they don't change over time. Cumulative dividends mean that any past dividends, any past preferred dividends that have not been paid have to be made up before common stockholders receive a dividend. So this protects the preferred stockholder. So, for example, if this year a company that has preferred stock or has issued preferred stock doesn't make their dividend payment, let's say it's $4 a year. So, Bank of America issues stock, then they say we're going to pay a $4 dividend every year on this stock. But for this year, for some reason, they haven't been able to make that payment because they don't have enough cash. So what happens if they have cumulative dividends is that next year, the company has to pay the $4 dividend from last year and the $4 dividend for the current year to the preferred stockholders before common stockholders get anything. So this is a protection for the preferred stockholders. Non-cumulative just means the opposite, that the firm doesn't have to make up any preferred dividend payments before they can issue dividends to the common stockholders. For that year, they still have to pay the preferred stockholders first. So in the example I just gave you where we had a year in which a company couldn't make their preferred dividend payment, well, so they'd be able to forget that dividend payment. And then the current year, they'd have to go ahead and make that one preferred dividend payment, the $4 payment to the preferred stockholders, but then they would be allowed to pay dividend payments to their common stockholders. So that's just a little added protection for the preferred stockholders. Preferred stockholders don't get a vote for the board of directors unless, and then there's some cases in which they're allowed to, if the company doesn't make its dividend payments to them. But if the company is doing everything that they're required to do with regard to the preferred stockholders, then those preferred stockholders don't get a vote like the common stockholders do. So the question that comes about with preferred stock is preferred stock really just debt? It has a fixed payment. The dividend is set and doesn't change. It has a sinking fund oftentimes, so just like common equity, in theory, the life of that equity is infinite. It'll go on forever. In reality, preferred stock often has a sinking fund, meaning that they have an agreement with their investors, the investors in those those securities, that over time they will repurchase those shares of preferred stock. Or they'll set up a sinking fund, an escrow account, for which they'll contribute money in order to repurchase those shares of stock at a later time. This acts a lot like a maturity date for these securities. And so the question often arises, is preferred stock really just debt? And a lot of financial analysts treat preferred stock like debt. Typically, preferred stock is issued by financial institutions. And what I mean by that is typically issued by banks, because banks have restrictions on issuing long-term debt, and so they're issuing preferred stock in lieu of issuing long-term debt. And this has to do with a bank's capital ratio, where they're required to keep so much equity relative to the debts of the firm. And just to think back to what is the main debt obligation of a bank, of a commercial bank, and that's typically the deposits of the bank. Deposits are a lot less expensive than taking out a long-term debt. If you think of the interest you get paid on your deposits, it's much lower than what a bondholder would receive from purchasing a bond from a bank. And so the banks would much rather use your deposits as their form of debt than they would taking on long-term debt. One last thing in this area on corporate bonds is that there's a corporate tax benefit. When one corporation purchases the preferred stock of another corporation, it only pays taxes on 30% of the dividends. And so, the idea of this is that they want to avoid triple taxation. So you may have heard the term double taxation, and this occurs when a company earns a profit and then they have to pay income taxes on that profit. And then after they pay income taxes, then they pay out dividends, and then you as an investor pay a tax on those dividends. And so that's referred to as double taxation. Well, when one firm owns stock in another firm, so firm one earns income and pay taxes on that income, and after that they pay out a dividend. Firm 2 receives that dividend, they treat it as income, they pay income taxes on that income, and then you receive the dividend from that company, and then you're paying taxes again on that dividend or on that original income from company 1. That would result in triple taxation. So only requiring them to pay taxes on 30% of dividends of preferred stock avoids some of that triple taxation. Municipal bonds are bonds that are issued by cities, counties, states, or other municipalities. The key thing to know about municipal bonds is that the investors don't have to pay federal tax on these bonds, federal income tax on these bonds, and typically they don't have to pay state income tax on these bonds as long as they were issued within the state in which the investor lives. As a result, these bonds pay a lower return than similar corporate bonds. That return is known as the tax equivalent yield. And it's calculated as I'm just going to put in here TEY for tax equivalent yield is equal to yield on similar corporate bond multiplied by 1 minus the investor's marginal income tax rate. So for example, if the state of Kansas were issuing a municipal bond, the state of Kansas has a AA tax rating, or excuse me, bond rating right now, and let's say the length of the bond is 30 years. What we would do is we would look up the yield, the average yield on AA rated corporate bonds with a 30-year maturity, and then we'd take the top marginal tax rate for investors, and we could figure out approximately the yield that the state of Kansas would have to pay on those bonds in order to get people to buy them. So let's say that the yield on similar corporate bonds is 6%, and the marginal income tax rate is 40%. The tax equivalent yield is equal to 0.06 multiplied by 1 minus 0.4, or 0.036, which is 3.60%. Now, municipal bonds are often issued on behalf of other organizations. So, for example, Stormont Vail here in Topeka is a not-for-profit hospital. They fund some of their expansions, some of their purchasing real estate and purchasing buildings through municipal bonds that that are issued for them by either the city or the county or the state. And the benefit to them is that they then get to have or pay these lower yields out to investors. Because if I'm an investor and I pay a 40% marginal tax rate, I'm indifferent between purchasing our AA corporate bond at 6% with a 6% yield, or my municipal bond at 3.6%, because my after-tax return is going to be the same. Okay. Like I said, hospitals often do this. They will often have municipalities issue bonds on their behalf, so they get to take advantage of that tax status, the special tax status of those bonds. On the other hand, if I'm not someone who pays a high marginal income tax rate, or I am an investor for an endowment fund or for a foundation and they don't pay taxes, then I don't want to invest in these municipal bonds, because I would be better off investing in the corporate bond, receiving the 6% and not paying taxes on that. Okay? Because if I'm an endowment fund, or if I'm a foundation, a public foundation, I'm not going to pay the tax on that return. And so I wouldn't want to invest in a municipal bond. The next type of bonds that we're going to talk about are international bonds. The first type is foreign bonds. These are bonds issued by a country for sale in another country in that country's currency. And that's a little confusing, so I'm going to give you an example of a Yankee bond. A Yankee bond is a bond issued by a foreign government and sold in the United States and are denominated in US dollars. Euro bonds are bonds issued by a country for sale in another country in the issuer's currency. So an example of this might be that the US government issues US bonds in Germany denominated in US dollars. And so if I lived in Germany and I wanted to give myself exposure to US dollars, because I might think that the currency is more stable, or maybe I want to take advantage of some differences in the valuations, or the changing valuations between the euro and US dollar, then I might want to purchase these bonds and get paid interest in US dollars and receive that principal again in US dollars. Some innovations in the bond market. One is referred to as an inverse floater. An inverse floater is a bond for which the coupon rate moves in the opposite direction from an index rate. So for example, I might say that we have an inverse floater bond that moves with the 30-year corporate bond rate, or 30-year U.S. Treasury rate. And so if the Treasury rate went up, then the coupon rate on my bond, my inverse floater, would go down, and vice versa. So if I buy one of these bonds, I have on here, what are your expectations for the future if you invest in an inverse floater bond? Well, typically, your expectations for the future are that rates are going to decrease, because then your coupon rate would increase. So that will give you a higher coupon return, coupon payment for your bond. Another type of bond is an asset-backed bond. And these are bonds that are backed with a security interest in assets. So some examples of asset-backed bonds are mortgage-backed bonds or mortgage-based bonds. There are bonds that are asset-backed bonds that are actually backed up by, if you have student loans, they're backed up by your payments on your student loans. So these are referred to as securitized bonds as well. And there's other types of securitized instruments that I won't go into too much detail here, but for, one other example is bonds that are backed up by car loans. So a bank issues a bunch of car loans, and so then they can securitize those loans by kind of combining them all together and selling off the cash flow rights of those bonds. So for example, when you make your car payment, that payment then would be divided amongst the bondholders for the bonds that are backed by those car loans. Catastrophe bonds are bonds that are typically issued by insurance companies. And when investors purchase these bonds, their money goes to an escrow account, a third-party account. If a specific catastrophe happens, so for example, several years ago, about 12 years ago, 13, 14 years ago, Hurricane Katrina hit down in the Gulf of Mexico. And there were some catastrophe bonds in that case that would pay out to the insurance company if that catastrophe happened. Okay. Companies, especially insurance companies that insure a lot in areas that are prone to natural disasters, such as down in Florida, on the East Coast, maybe even in the Midwest with regards to tornadoes, they might issue these catastrophe bonds. So they're typically issued by insurance companies. The investor's money goes out to the insurance companies if a specific catastrophe occurs. If that doesn't occur, then the investors receive coupon payments and then receive the principal back at maturity. The coupon payments are essentially insurance payments made by or think of them as insurance premiums made by the insurance companies to the investors in order to receive this type of insurance. So what is the purpose for issuing catastrophe bonds? The purpose of issuing catastrophe bonds is to protect the insurance companies from large catastrophes And so what an insurance company can do is they can see that they have a risk of, let's say, a large hurricane hitting Florida. And what they can do is specifically protect themselves from this type of risk by issuing these bonds. And so if that hurricane hits and they have a lot of big payouts to make, then the proceeds from these bonds would go to the insurance company, and so they can make those payments to their customers. If the catastrophe doesn't happen, then the bondholders receive the principal payment, and they receive the coupon payment being made by the insurance company. As I mentioned before, this is like a premium, an insurance premium, being paid to the insurance company. An index bond is kind of like I mentioned up here. Let's see. I mentioned up here floating rate bonds. They're a lot like floating rate bonds. They specifically float with an index. A very common type of index bond is referred to as a TIP or TIPS, and these are Treasury inflation protected securities. These are issued by the U.S. Treasury. The yields on these bonds float with the rate of inflation plus a small premium. The returns are typically lower than similar U.S. Treasuries, than U.S. Treasuries with similar times to maturity. The purpose of these TIPS is to protect investors from an unanticipated increase in inflation. So let's say, our average inflation rate is about 2% a year, but let's say the rate of inflation goes up to 10% in 1 year. Well, if you owned a TIPS bonds, then you would be protected against that because your return would also grow to 10% plus. It's usually around 1.5% is the premium on that. And so this protects investors from inflation risk. And they are index bonds because they are indexed to the CPI. And that's all I'm going to cover on this video. The next video will start with bond pricing. And that's it.